Zoom.
There we go. There it is. Yeah. So the last time we promised that we would.
Last time we promised that we would go deeper into finances specifically. So I do want to know, go ahead and throw in the chat, what specifically are the areas of finances that you are wanting to dive into? And I'm going to give you a question. This question is going to show up later, but you don't have to write the answer to this, but I want you guys to be thinking about it. And the question is this: where in your finances are you flirting with disaster? Ouch. Where in your finances are you flirting with disaster? This is a question I always like to give credit if I can. I hear this question from a group called Go Abundance, where we are very vulnerable about finances, showing profit and loss and income statements and net worth. And we ask each other the question, where in your finances are you flirting with disaster? So I want to hear, I want you to at least be thinking about that, right? Whether you put that in here or not, but I want to know, why are you here? And I hope that you're thinking about what's the area that you really, really want to focus on. Okay. I hate these multiple screens here, guys. I'm not a professional.
So we've got a couple in the chat, Seth. We've got big team management and how to cut appropriately. What do we need and not need? Percentage of profit and loss. We've got a rainmaker who wants to spend. I don't know anybody like that. Seth, do you know anyone?
I can relate to this person. I can relate to this person.
I am a horrible hoarder, and I don't do what I need with my income because of that fear, not putting enough away, debt relief, and keeping a budget. Lots of good stuff here. Okay.
I love it. Well, hey, we're going to dig in. We're going to get through as many business mistakes that we see, and then as many personal mistakes as we can see. I tell you guys, take a lot of notes. Feel free to reach out to us on, kind of one-off questions that you might have. We'll dig into this. We'll try to leave it some time at the end for Q&A if we can. So first off, the single biggest mistake, and if you were on a couple of weeks ago or about a month ago now, we covered this as well, is people do not have the right accounts and the right credit cards or debit cards if you're a Dave Ramsey fan, and they commingle funds. So beginning of the year, the very first thing that we would want to see people doing is, dear Lord, what is this? Is setting up the 6 accounts you need and the 3 credit or debit cards. Okay, so here are the accounts you need. Take a picture of this. Or snap it on your phone if you're driving. Here's the accounts that I want you to have: business checking, business savings, tax savings. Those are business accounts. Next, you want a business credit card and an owner credit card. We will explain what an owner credit card is. And then on the personal side, at a minimum, household checking, household savings, an investment account, and then a household credit card. There's 9 things on the page. Put in the chat the number of these that you have. So 1 to 9, how many of these do you have? Go ahead and throw those in the chat. Katrina, any comments that you have on this or mistakes that you see agents, entrepreneurs make?
Yeah, so I'll see one of the biggest things that I see mistakes that I see entrepreneurs make is nothing for tax savings. And frankly, that does not need to be an account that you can even access. We'll talk about paying yourself payroll, you can do that in a way that you can't even touch the money, but also that they make it too easy to move the money in between, and they don't have a system for what money goes in which buckets and when it goes there.
Yeah, absolutely. So again, guys, these are the accounts that you want to have. And maybe if we get a chance, we'll be able to walk through kind of the flow chart of them. But just understand there's a reason for each one of these. The 2 that I see people miss out on the most is that if you don't have an investment account, chances are, if I were to ask you, like, what are your long-term investing goals? You're like, I don't know. I'm kind of just trying to survive right now. That for me is the number one reason. It's like, set it up now. Fund it with a very nominal amount if you need to, but that investment account is, at the end of the day, perhaps the most important account on this entire page. But the business savings and the household savings accounts, that's what we consider as reserves. And this really is, in this economy, this is the difference between people making it and people not making it, are the people that have enough reserves in their accounts. So, and we'll come back to these credit cards in a second. Just understand the goal is to keep these things very separated out. All right, number 2 here. Mistake number 2, they don't set aside for taxes. It's certainly a lot of people on here. I actually see a few names on here that are not in the real estate industry, which is awesome. I think any small business is dealing with this, but the reality is a lot of us came from a world in which we had a job. And when you had a job, the amount of money that you ended up taking home was not the same as the gross income, right? Because the federal government did you a favor, they took out money for taxes. And now you have a problem because if you've been in real estate or a small business owner for 2 years, you can be 2 years behind on your taxes that quickly. So here's what we would recommend for certainly the agents that we work with. Number one, if you have no better plan, then take whatever your commission income is and set aside 20% of that amount. Now, I actually think we were kind of trying to do the math, Katrina, like once we calculate in expenses, we think that this is perhaps overly conservative, right? But if you have no better plan right now, put 20% aside. And then the second way to do it, and I think you actually helped us do this on the daily group, is salary withdrawal. Do you want to explain that a little bit?
Yeah, the idea is that you can make yourself a W-2 of your own company. We're going to talk about LLCs, S Corps, et cetera. That's a kind of a broader concept. The idea is pay yourself a paycheck. Just like if you had an assistant, you would pay them a paycheck and taxes would come out. You can do the same for yourself. And then again, that then goes into a system with the payroll company that is paid automatically to the government. You can't touch that money. So if you have trouble, if you have challenges, not touching money, if you have access to it, this is a really great way to do that. And there's a lot, your bookkeeper can often do that for you, or signing up for something like Gusto or ADP makes it super simple.
Yeah. Yeah. And by the way, Jamie, I see your hand there. I will try and grab it in a second. Do throw it in the chat. Katrina, go ahead and grab a couple of these questions so as we're getting them. If you're just getting started, do you still need a business account? Yes. Yes. Our 18-year-old just started a business. The first thing I did was go down to the bank with her and set up a business account. These accounts are exactly what I would recommend everybody have at the very beginning. However, and I appreciate the nuance of that question. It doesn't necessarily mean that when you go to the bank, you say to them, it's a business account. It's just that for the purposes of your finances, you have this many accounts. You are labeling it as a business account. That doesn't mean that you're going in and paying extra for them to give you something that requires a higher minimum balance or a higher monthly fee or something of that nature. It is simply a separate account.
And many banks, you can just go on the app and say, add an account. They might have a minimum balance requirement after a certain number of accounts, but you might just be able to do it in your bank's app. And that way it's at least two separate accounts.
Yeah. By the way, I'm seeing a couple questions in there and I wonder actually, shoot, am I going to?
So I feel like, there's a lot of questions about paying yourself as a W-2. I'm going to mark that down in a parking lot that if we have extra time at the end, we'll talk about paying yourself.
And I'll try and actually walk people through the threshold, like the minimum and the maximum that you want to do on that. Here's what I would say. There's probably not anybody on the call right now, and I haven't looked through the list, but there's probably not anybody on the call that we wouldn't give some pretty similar concepts. But number one, I would recommend everybody set up an LLC. And then I would recommend everybody after setting up that single member LLC, which simply means it's the simplest type to do because you are the only member of it. And almost in any state, it makes it way easier to do. And then number two, elect to have it taxed as an S Corp. And just because this is being recorded, and I used to be a CPA and I'm not anymore, so go talk to your own CPA, go talk to your own accountant, go talk to your own attorney. But this is what we did personally, and I would highly recommend it. And just verify that with anybody else that you trust that's active in those professions. An S Corp is not an entity. Go ahead, Katrina.
You got two questions on that. Oh yeah, apparently Zoom wants to give me balloons. What if they don't make enough money for their account to feel like an S Corp? I've heard that as well, that there's an income threshold where S Corp makes sense and doesn't make sense. And then also, what about partnerships? So
yeah, so partnerships are definitely more nuanced. I need to get more information on that to understand it. And it's also one of the ones I would very quickly punt to a CPA. I'd want to understand who's the partner, right? Is it a spouse? Is it an unrelated person, et cetera? The question about what was the first question? If you don't make enough money?
Threshold. So if you're not making, let's say you're making $75,000 a year and your accountant says that's not enough money to justify an S Corp.
Yeah. I would ask them what their number is and then ping back with me on what that answer is. I don't think it needs to be terribly high to justify the S Corp, but we'll walk through if we can at the end, like the threshold of what you're trying to do. The whole point of an S Corp is to pay a type of tax like the FICA and Social Security tax on only part of your earnings, right? Part of it is tax and you have to pay that. And the other part, you avoid it and it's paid out as distributions and it saves you a little bit. All they're saying there is that the juice might not be worth the squeeze if there's not enough, because you still have to pay yourself a certain amount as an S corp, as the owner of the company or the managing member of the company. So we'll come back on there. And Howard, thank you. I love having somebody in here. 100K for an S corp is a threshold, and that would seem to pass the litmus test of just reasonability there too. All right. So again, solution number 3 or problem number 3 is they don't have an LLC. If you don't have one and you are starting 2024, put an LLC on your list of things that I think you should absolutely have.
By the way, as a business entity, if I am paying you 1099, I can retroactively change, I can send your 1099 to an LLC that was in existence. You can't create one in December and have us tax you in that LLC for the entire year. So set it up now. That's really important.
And it's interesting, Katrina, like obviously I work in Maryland and now in Texas. It was not until January 1st of this year that in Texas, agents could be paid into an LLC. So I realized that we're giving this advice a little bit because of the experience we have inside of our brokerage in Maryland. And we're like, why, when we are cutting checks, why are we not paying them into an LLC? If you are in a state where you are able, in your profession, I'm going to assume real estate for this conversation, if you're able to be paid in an LLC, for goodness sakes, take advantage of that opportunity, right? Mistake number 4, they don't have an initial capital contribution to reserves to fund business expenses. This, I think, is just a fancy way of saying, when you got into the real estate business as a self-employed small business owner, you were comparing different opportunities out there. And maybe you were thinking about starting a fitness franchise or buying a tire shop or doing something else. And you got into real estate. And the reality is real estate costs almost nothing to get into. But at the same time, we'll watch people come into it extremely underfunded, even though it requires very little. So what's the rule of thumb that you're giving, Katrina, to agents that are considering getting into real estate, and you're like, you really need to save up for this?
It depends. I say you need a cushion and you need a pipeline, and the length of your cushion depends on the depth of your pipeline. If you're coming into something and you're saying, I've got 4 or 5 people ready to go right now, 3 months is probably sufficient. I wouldn't ever have less than 3 months of that capital contribution just in an account as a reserve. But if you're coming in and you're saying, I got nothing, well, you're probably going to need 9, 12 months worth of reserves, because it's going to take time to get that rolling. And honestly, there's people in other businesses too. I would say it's the same thing. When do you expect income to come in? What does your pipeline look like? And that determines the level of your cushion.
Yeah, it just, I am always amazed at how small the barrier to entry is into real estate, but because it's so small, people actually think it goes from small to non-existent at all. And I would want you to have at least a 6-month runway for your business expenses. The reality is for your personal expenses too, and make cuts at home to fund your business. Make cuts at home to fund your business. All right, mistake number 5. They don't operate on a plan, and a more fancy word for a plan is a pro forma. So when you are considering any self-employed venture, certainly we could talk specifically about real estate right now. There are people that have done this before, and people will say, well, how could I put together a plan? I don't know what it's going to be like. The reality is that's what a pro forma or a budget is. I mean, that's all that is, right? This is an estimate of income and expenses. And the way that we've learned to do it over the years is we'll almost have a best case scenario, a probable scenario, and a worst case scenario. And then we will work out the income, right? So that's really when you think best and worst case, you're really more talking about how many houses will I sell, or what will my income be? And then you look at how am I going to adapt the expenses in each of those scenarios. Katrina, because you see this on just not just the agent side, but also the brokerage side, like what do you notice in terms of how people plan or fail to plan when it comes to these scenarios?
Yeah, I mean, we're in an industry that it's had a lot of volatility lately, and a lot of folks a lot of people get into real estate because they're very optimistic and they think, oh, I'm going to increase my income by 25% this year, and they create a budget around it. Create a budget that is around no more than what you made last year, and then adjust as you go throughout the year, rather than creating a budget around your goal. Create a budget around what you have actually done in the past and allow that to be your pro forma, and then reevaluate as needed.
Yeah, if anything, sometimes I'll watch people, they'll hire a bunch of agents. So they'll hire salespeople, and then they will project out, oh my gosh, look at how much we're going to sell. and they will base their expenses on this like best possible case scenario with all these additional salespeople. And I'm like, cut your projections for unproven talent, new salespeople, cut those projections in half, maybe cut them by 2/3 or 3/4, but reduce that dramatically, be very conservative in assuming increase in income, and be very conservative when you're balancing your expenses or considering those.
And that has to do a little bit with influencing your activities and influencing others' activities. Leadership is very different than doing. And doing affects your bottom line much more quickly than leadership does. Leadership is a next level lesson for a lot of agents, and they don't realize that. They think, oh, when I got in the business, I did 10 deals my first year. They want to do 10. I can help them do that. They don't realize that they're unique to that person. So understanding what can you control and what can you lead, and you're going to have to consider the two differently.
Yeah, love it, love it. Mistake number 6, they don't spend, or we'll use the word invest enough on their business. So let's talk about this real quick. First off, when you consider your business expenses, the question is, what of those are you actually considering as investments? I'm amazed at watching when the market contracts, we will start to cut spending on things that really, those are investments. Like, you're not going to grow your business. You're not even going to survive if you aren't able to distinguish for yourself what are the investments in your business and what are the expenses that should be cut. Katrina, you teach a lot on the MREA, right? So MREA stands for the Millionaire Real Estate Agent. You probably have it handy.
It's right here.
Right here. So Millionaire Real Estate Agent has a chart in it. I'll show the chart right here. Let me go back to this slide for a second. Here's the general rule. 30% should be going to expenses. Of that 30%, there's 2 big items inside of that 30% that accounts for almost all of it, right? But 30% to expenses, and then 30% to cost of sale. So we'll show that in kind of a slightly more detailed way. Here's that whole part of the salaries is between basically 10 and 15%, and lead generation or marketing costs are really consistent 10%. This is all, if you add all this up, this is what added up to that 30%. Katrina, what do you say to people when you're looking at their spending and they're a newer agent, or they've got a small team, or they're somewhere in that category?
Yeah, so a couple of pieces. Usually people who are earlier on in the business aren't spending enough money on the business, and they think that they're making more money, and as their business grows, they don't want to spend the money, but they're underspending. And then you get to a point that you have to spend money to make more money. You cannot create more income if you don't create more time. Easiest way to create more time is through leverage, which could be salaries, automation, etc. But then on the other end of the spectrum, I see people who are further along in the business and they are spending way too much money. They're making 70,000 take home after 500 GCI. And I'm like, that's not a life worth living. Like, that's, you need to figure that out. So having that a constant look at it of, am I spending enough money or am I spending too much money? And also, if I'm spending too much money, does that mean I am, or is it a owner expense rather than a business expense, which we'll talk a little bit more about later as well.
Yeah. So here's
that's just a chart kind of showing that. Where should that money go? Your total expenses. And that's for a new agent who's making 100,000 GCI. They're like, oh, spending 30,000 of it on expenses. Like, I made 100 grand, 100 grand and 70 grand is vastly different, but understanding that is not an expense. If you make it an investment, I'm hiring somebody to free up my time to go do.
Yeah. I love it. Here's something that I'd like everybody to do right now. Write down, you don't need to post this in the chat, but write it down for yourself. What was your GCI last year? That simply means, what was your top line revenue that you generated last year? And then write down these 3 numbers. How much did you spend on lead gen? Or another way to say that is marketing costs, right? So again, hypothetical, Katrina kind of gave you that scenario in the last slide. If your GCI last year was $100,000, then I want you to write down, how much should you spend on lead gen? And here's the thing, if the number that you wrote down was less than 10%, we would tell you that you might be starving the golden goose that lays the golden eggs. Okay. If the number you wrote down was less than 10% of your GCI number for amount spent on lead gen, then you might be starving your business. Next number to write down, is how much did you spend on admin leverage? And then a third that is a little bit more complicated is how much did you spend on sales leverage? Admin leverage, simply what we mean is you are the salesperson, you are the lead rainmaker of your business, and you're like the surgeon in the operating room, and you've got this, you need administrative support. That could be an outsourced transaction coordinator. That could be somebody helping you write your offers. So I'm not talking about sales support right now, but I am talking about like just all of the paperwork stuff. There is a great book, Katrina. We don't have this in the slides. I don't know if people can see how small my face is here on the screen. But guys, this is a great book, Buy Back Your Time by Dan Martell. He basically covers this whole idea of you realize that at some point in time, when you hire admin help, you are doing it to buy back your time, and you should not feel guilty about that. Okay, so write down how much did you spend on admin support. Here's the thing about admin support. If that number is also not about 10% of your GCI, then you are the admin. You are the admin of your own business. And I would tell anybody, if your GCI last year was $120,000, budget $12,000 somehow. Maybe it's for an outsourced TC, maybe it's a part-time admin, it's something, but budget $12,000 or 10% of that number for admin leverage. And then Katrina, I think, unless there's a question in the chat about it, we'll hold off on the sales leverage. But I'm talking here for anybody that is building a bigger team. When you find yourself getting much over the $100,000 GCI threshold, and you've done everything you can with your own units, with your own production, one of the first things to consider is getting help on the showing agents part of your business. Right? There are ways to get a little bit of leverage here and there that don't break the bank, but absolutely help you have a life worth living inside of this business that you're trying to build. Annie, you want to chime in with that?
Yeah, and we're going to do our next one of these, I think, is about hiring that assistant, hiring that person, and what do you look for there. But one of the pieces that I will shout loud and proud to every realtor is when you add salespeople before you add admin, not only are you your own admin, you're now their admin. And usually you add a salesperson, they don't know as much of what they're doing. So you're spending, your business goes backwards because you're the one who's helping them write the offer, the paperwork, etc. Super important that these are dominoes. One comes before the other.
And by the way, I love what Susan asked in the chat there about, okay, so what if we're at about, 400K, how do you figure out those numbers? That is exactly the spot that Alice and I were at when we started to maneuver these numbers. So first off, if you're at 400K, the first thought that I would have is, are you spending about 40 grand a year on lead gen? That'd be a question. Question number two is, do you have a full-time admin or part-time admins, maybe virtual, maybe in office, that your budget is around 40,000 a year for, right? And then the third thing is, you're at the point there where if you are doing all of the work with all of the buyers, et cetera, yourself, my guess is you're approaching burnout, right? Now, there could be a few exceptions. Somebody could be watching this at your average sales price is just so high that really is just a few transactions and it's not a big deal. But I am a big fan of buying back your time early in this business and learning to grow that way. There we go. All right, moving on. All right, mistake number 7, they don't separate above and below the line expenses and blame their business for below the line expenses. So Katrina, explain to everybody real quick, what does below the line, above the line mean? We learned this as a concept through the office.
So, and we actually learned this on the team side back in the day when I was Seth's director of operations and I was accountable for profitability of the business. And we would look at the P&L and Seth would say, the business is not profitable enough. And I'd say, that's a bunch of bull. You took all of your friends out to dinner last week and put it on the business credit card and called it a business expense. And I know so what we realized, and then when we opened up a brokerage, realized that there's a set of expenses that are what we tell that are actually, for Uncle Sam's purposes, they are business expenses. However, they are personal ownership choices that we're going to make. That training that you chose to go to, the meals that you took a colleague out that you chose to take the bill for, but wasn't necessarily in the budget. Those are below the line expenses. So when you actually understand the profitability, Jeff said Seth can take him out to lunch, out to dinner for business.
There we go.
Yeah, but when you evaluate the profitability of the business, you evaluate it based upon the items that fit within the budget. And that actually eliminated a lot of the arguments that we had when it was but I want to spend this money on this particular thing and I want to put it on the business. We just agreed, okay, well, maybe that's a below the line expense. And that's great. That's perfect. You want to buy a Tesla and put it on the business? Uncle Sam says it's okay. You should. Should that affect the profitability of your business? Probably not.
Yeah, and Katrina, here's a great example, right? So the moment before you were a real estate agent, you had a cell phone. And the moment after you were a real estate agent, you also have the same cell phone. And now you start to write it off as a business expense. Again, do whatever you want. I'm just talking for a friend here. But that moment after, when you start to write off your cell phone, if you were to come in and be like, oh my God, it's so expensive to be a realtor. Look at all these expenses. I've got this expense to Verizon. I'd say, wait a minute, you had that expense yesterday. That's not actually a new expense. That is, in a way, the definition of an owner perk, right? So go ahead.
So to Susan's question there, is it a profit? All of it, I would consider it to be GCI minus cost of sales minus business expenses minus owner's expenses equals the profit that you're going to tell Uncle Sam. The profit that you are going to hold your business accountable to is going to take the owner perks, the owner expenses out of that. So it will be GCI minus cost of sales minus business expenses equals the income that you're going to really look at the business and say, is my business performing the way that I need it to? And are my categories correct? But if you double the amount of salaries because you have a personal assistant who also returns your Amazon packages that's on the business, that's all well and good. That person is helping you with the business, but that's not a budgeted item. That should go into owner's expenses rather than business expenses.
Yeah. And again, understand that this is a way of saying you should be tracking your own expenses and you should know what is like almost purest expense for the business. And what are things that you're like, because I own the business, I'm choosing and able to write this off. Susan, the danger comes in if a few of us get in the room and we start to try to compare averages, right? Well, what's your profit margin? Oh, I'm at 70% profit margin. Well, I'm at 20% profit margin. And all of a sudden we don't feel like we can benchmark against each other. This isn't about comparing for like, who's the better human. This is like, hey, I'm trying to learn from what you're doing and you're trying to learn from what I'm doing, but we're talking in language that doesn't help. And so when you start to strip this stuff away, the owner perks, all of a sudden the profit and loss statements for two good agents look about the same because you've separated out their personal choices. And this is what I personally use that owner credit card for. So if you guys remember, issue number one was I want you on the business side to have two credit cards, a business credit card and then an owner credit card. Now understand, those are just regular credit cards, right? Any two credit cards in your wallet right now could become what I'm referring to. It's simply that is what you use each of them for. So if this afternoon I go in and I pay my board dues, I'm going to put it on one credit card. And if this afternoon I go in and I book a flight.
Dinner with Jeff Wu.
Yes. And if this afternoon I call Jeff Wu and we go down to Northern Virginia and have dinner, that's going to go on a different credit card. That one is going to go on the owner perks credit card. And this has been an absolute game changer to help me actually get a sense for how my business is doing. By the way, here's the tip. When the market starts to correct, the very first thing that you need to make cuts on is that owner perks credit card. That's where you will notice it first.
And that's also where if you have a bookkeeper, it makes their life a lot easier because now they know whatever is on credit card number 2, they just classify it slightly differently in their software. And they should be able to pull you a P&L that has both credit cards on it and a P&L that only has the one credit card, a P&L that has kind of both sets of books on there.
Yeah, absolutely. All right. So number 8, they don't keep score regularly. Guys, this is what a lot of us agents look like, especially when a market corrects. We do not look at our finances because we're like, I really don't want to. It could only possibly be bad news that would depress me even further if I do. And the reality is that is the kiss of death in a business. You have to be willing to look at your finances. And Katrina, this is a great example, right? The daily group, candidly, we still don't look at our finances as often as we do with the market center because the market center requires us to close the books every 30 days like clockwork, or we get penalized, right? So there's no room inside of our business to look like an ostrich here. And the goal is review your P&L monthly. Give them the comment here about the chart of accounts and then anything else you'd add about the profit and loss statement.
So the Millionaire Real Estate Agent book has a chart of accounts there. So if you Google Millionaire Real Estate Agent chart of accounts, you can find a spreadsheet that has those. All that does is it makes it so that we're all talking about the same things. A lot of real estate bookkeepers use that chart of accounts, and then we can compare apples to apples. But one of the biggest pieces that I find, if you go hire your bookkeeper from down the street, who's a really great bookkeeper, they don't necessarily understand real estate math. And real estate math works a little differently than other businesses. So with the MREA chart of accounts, that you include all of that cost of sales, which is everything that comes out before you get the amount that hits your bank account.
And all chart of accounts means, all that is, it's a list of categories. It's just using the same label to categorize stuff so that you are consistent with yourself year over year, and you are consistent with other people inside of this profession. If you're watching this and you're a loan officer, sorry, I don't have a loan officer chart of accounts. You should build one, right? Or go research it. But the other thing, Katrina, is sometimes, and I don't think that we have a slide on this, so we'll say it here. Sometimes if you just give this to, I'll say, a normal account, they will look at the first check that you get, right? So understand that's after you pay your team, after you pay your salespeople, after you pay your brokerage, after you paid out any referral fees. And that is what they will consider to be your total gross income, the highest number on their income statement. What doesn't work about that? Or where does that get people in the wrong direction?
They don't have any idea what their cost of sales is. Remember, we talked about income minus cost of sales minus expenses equals income. If the GCI was $10,000 and you paid 20% to your brokerage and you got $8,000, the income was $10,000. Your cost of sales was $2,000, and a lot of traditional bookkeepers will literally just only log into your bank account, and they will consider whatever was deposited to be the income. And then you end up spending. We've had people who say, oh, I've got a great referral business from other agents throughout the country. And what we found out is 75% of their business was referrals. And that's all well and good, but they were paying out a much larger cost of sales. And they needed to consider, do we need to diversify our lead generation, or do we need to cut expenses because their profit margin was too low because of it?
Yeah. By the way, a personal pet peeve for both of us is when agents don't understand that if an admin fee is charged to their client on a transaction that they brought to the brokerage, that number should be included in the total income that you generate, right? Now, if your brokerage collects all of that admin fee, no problem, but understand that is an expense that should be deducted from it. It's not like you should just calculate the starting number after that expense is deducted.
Yeah, if you get $10,000 commission and there's a $500 admin fee and all $500 goes to your brokerage, that $500 was income and then cost of sales.
Yeah, that's exactly right. All right, and again, mistake number 9 has almost been covered elsewhere, but I can't stress this enough, guys. A commission check is so different than a paycheck. A commission check is so different than a paycheck. A commission check is top line revenue, and whenever we will watch an agent collect a commission check and treat it the way they were programmed to treat a paycheck. How do you treat a paycheck? You assume that taxes have already been taken out of a paycheck, and you assume that whatever the amount of the paycheck is yours to spend however you please. A commission check does not work that way. You have to go back a few mistakes ago and look at that list of things where you need to invest your money. Are you reinvesting part of that commission check, not just in setting aside for taxes, but are you also reinvesting it in a lead generation and salaries and other operating expenses for your business? Anything else you'd say on there?
Oh, that's good.
All right. And mistake number 10, they miss out on tax deductions. This could be an hour or two in and of itself. We'll give you a few right now to think about. Number 1, who's familiar? Put in the chat if you are familiar with the Augusta rule. In fact, if you're familiar with it, put the sport in the chat that this relates to. Put the sport that this relates to. The Augusta rule.
Cheryl's got it.
There we go. There we go. When I just get stupid question. Okay. So the Augusta rule. The Augusta rule is how we write off our personal, the use of our personal residence as a business expense. Go Google it. We won't have a lot of time in here, but the year before I learned this and the year after I learned this was about a $50,000 change in our write-offs. So it was a $50,000 change the year before I knew this and the year after, and that translated into real money. Number 2, hire your kids. I think I actually put out in my newsletter this week the amount, I believe it's like $13,850 is the 2024 rule. So what this means is a dependent child can earn no more than $13,850. Don't quote me on that. Go check it. Or they have to file a tax return, right? So if a child only makes that amount, they do not have to file a tax return, and they're not paying federal tax. They're still paying FICA and Medicare on that small amount, but they're not paying federal income or state income taxes. The benefit of that is if you have an actual reason to hire your children, which there's a lot of variety there, that's a write-off for you, and it is not taxable for them.
And that's for any business. That's not a real estate rule. That's just a rule.
Yeah, that's just a rule. Section 179, if you are considering getting a car, there's certainly ways to write stuff off, but the magic number is 6,000 pounds, that the acceleration of how fast you can deduct the cost of that car changes significantly, at least currently, over 6,000 pounds, right? So if you're considering a Tesla X and a Tesla Y, the Tesla X qualifies there and the Tesla Y does not, unfortunately. Doesn't mean that you can't write it off eventually. It just really accelerates it if it's over that 6,000 pounds. And then maxing out retirement contributions. This is probably going to vary for different people on here, but I just say, like, if you don't have a financial planner, get one. Walk through your scenario with them. And the very first question I want you to say is, what do I need to do to make sure that I'm deferring as much as I can under the, based on the income I've got. You might be making too much money for Roth IRA contributions, or you still might qualify for those. But maxing out retirement contributions is just something that we've committed to doing as long as we've been in real estate, and it's been helpful to watch that grow. Katrina, any comments on there?
Oh, good to go.
Go. All right. All right. Let's talk about personal finances. Mistake number one: people not having a household budget. So we're going to walk you through a few concepts of a household budget. By the way, grab that QR code. In theory, that should take you to to one budget. We're kind of working on putting together a few others, but here's just one that we found. And if you don't have one, this is going to be better than nothing for you. At the end of the day, use an Excel spreadsheet, use a Google Sheet and put one together, but this will give you a wireframe for it. So 3 types of expenses in your home budget: recurring monthly expenses, day-to-day routine spending, and non-recurring or random spending. So let's talk about these. Recurring monthly expenses. This is the things that, like, they are due on a specific day, right? So this could be your cell phone bill. This could be your mortgage. This could be rent. This could be anything that is specific on a day. There's going to be a lot in your budget that don't fall under these, but these are the absolute, this happens on this exact day, and you need to be able to manage for this in cash flow. So once you write this out, you number your paper 1 through 30, and some things are due on every certain day. They're not going to change, barring the unforeseen. Okay. Part 2, section 2, is going to be day-to-day routine spending. So there's several ways to kind of go about this. I'll just tell you what we personally do. Alice and I, from time to time, will go back and we'll kind of recalibrate our spending, and we will just take our household credit card and our household checking account, because between those two documents, we will have all of the spending that was for our household over a period of time. So we'll just go back 3 months and we will start to look at averages, right? And you will start to see trends figure out. I mean, yes, it's climbing up, but the reality is groceries have an average and they feel pretty consistent. Gas could feel pretty consistent over time. The BG&E bill, right? Gas bill, et cetera. All that stuff ends up feeling fairly consistent. Then, if as needed, set up other accounts. So this is different than what we talked about before. I told you the 3 main accounts that you'd want to have in the personal side. But if you want to, if you've got specific type of spending, go set up an account. It might be saving for kids, college funds. It might be anything that you're wanting to really earmark on the spending side or on the saving side. Go set up a separate account on that and transfer a set amount of your money at the beginning of the month into those accounts. Or if you're familiar with the Dave Ramsey system, withdraw it and put it into cash in an envelope. I still know people that are using that for going out to eat or luxuries or their budget for entertainment. Katrina, anything you'd say there?
Yeah, a couple of pieces, like this is your groceries, this is your gas, etc. If you are going to do nothing else, just start tracking it now, because eventually you will have those averages. If you're like, oh my gosh, to go back over the last 90 days and look at it and figure it out is too much, well, just start tracking it now. I personally log into my personal budget once a week to look at things we reallocate. That's also where you find things that expenses that shouldn't have been there. But as far as those accounts that you might put those other things in, recommend them not being super liquid, that they should be liquid, but less liquid than in your own bank account, where we talked about.
Might be a separate account. Yep.
Right, a
Or
separate
a
bank.
separate bank.
Separate bank. It
And
might take 3 days instead of 3 minutes to transfer.
And then the third category would be non-recurring and random expenses, right? And a good example of this is like Christmas presents or gifts in general, right? They're things that, or car expenses. They're things that they're going to happen throughout the year, but they don't feel like they're recurring on a monthly level. And this is really where you've just got a budget, figure out what the average is. And the most important thing is put this into a separate account as needed. So you're earmarking money specifically for that purpose. So those are the 3 types of expenses. If I have somebody print out all of their expenses over the past 3 months, these are the 3 categories that we would categorize things in to figure out what it is. All right. Benefits, your monthly spending begins to look the same, right? Once you start to earmark for the random stuff and set a part of it aside, 1/12 of it aside every month, you can transfer or withdraw that monthly spending, and it helps you save for upcoming or unexpected expenses. 3 types of budgets. Katrina, we've probably been using this language almost as long as we've known each other, and I'm pretty sure we got it from Brian Buffini. The idea of survival, stability, and success. Anytime you are thinking about your business budget or your personal budget, think about if everything hits the fan, what is my absolute survival numbers? What would those look like? Then have kind of the next level down. What would be my stability budget, right? And then ultimately the life that you want to live, what would be your success budget?
And guys, with these personal budgets, when your business starts to decrease, the first thing you do is move up a level in your personal budget.
Yeah.
Don't hope, oh, I hope everything else comes back. You don't say, I'm going to cut my business expenses. The first thing you do is you say, all right, we were going to go to Italy this year. Instead, we're going to go to Ocean City because business is down.
Yeah, that's exactly right. All right, mistake number 2. They have debt with no plan to get out of it. This is that question I asked you guys at the beginning, but maybe some new people came on. Where in your finances are you flirting with disaster? Where in your finances are you flirting with disaster? And it is generally going to be around debt. So here's our advice. Number 1, immediately stop the bleeding. Cut your expenses as deep as you need to so that the bleeding stops. You are not going further into debt next month than you were this month. Number 2, cut the carbs, right? I mean, metaphorically or physically, and the ability to go further in debt. And number 3, use Dave Ramsey's debt snowball. There's kind of an example here. I'd say grab a picture of this, or more importantly, simply Google debt snowball. There's probably 1,000 YouTube videos that explain it. But Katrina, can you explain briefly, like, what is the concept of this debt snowball?
Yep. So the idea is that if you have an extra $200 to pay towards debt each month, that first you put that towards the lowest balance. Once you pay that off, you put the regular payment plus that 200 towards the next one, towards the next one, towards the next one. You pay off the smallest amount first, and then put everything that you're putting towards the next one to snowball the payment on that debt.
Yeah. So in this case, you see that the green 200, it's like that's all the extra they had. And the point is, you don't diversify. You don't put $20 against each one of your debts. You take all of that extra money you have by making cuts in your budget, and you like a laser, you put it all towards one. So the debt snowball is a great path. There's a couple others, right? So there's different schools of thought. Robert Kiyosaki would say focus on the highest payment amount, right, to get traction. Susie Orman would say pay off the highest interest rate, and then Kel Siddiqui would say pay off the one that has the most emotional baggage. In my case, I had school loans that did not have a high interest rate, were not the highest payment, but we had some like family drama that at some point in time I just got sick of looking at. Like, I just need to pay that off. Honestly, more from an emotional reason than anything else. So that's what we did. Then once you've done that, pay off your balances in full each month. Now, I'm saying with auto payments, Katrina will actually correct me a little bit here. All I can tell you is I want to make sure they get paid in full each month, and you never go back to carrying balances on debt again. Anything you'd add, Katrina?
Yeah, if you're one of those people who's going to forget to pay it, make it like that automatic recurring payment for variable bills. So a credit card bill, things like that. We don't put it on auto payment because that's a reminder to log in and just peruse the statement and make sure nobody was buying, Chinese TVs on the black market and putting it on your credit card. I actually had somebody once who they were putting $20 here, $30 there, $50 there that we didn't notice for 2 months. And we would have never noticed if we weren't looking at the statement.
Yep, absolutely. Absolutely. All right, mistake number 3, they don't have a plan to pay themselves first, save and invest. So here's 2 books that if you've not read these 2 books, put these on your list for 2024, The Richest Man in Babylon, and then also Profit First. So put these 2 books on your list. Here's the point, and what they'll all have in common. You need to set money aside first to pay yourself the profit. And then your goal is to automate that process as quickly as possible. Otherwise, we just get into this rat race of every time our income goes up, we expand our lifestyle to fit it, and we're never actually taking chips off of the table and investing them. So pay yourself first. And what they mean by pay yourself first is not pay yourself and go get your nails done, right? They mean pay yourself and invest it into your future.
Seth, you need to stop getting your nails done.
I know. I'm totally going to stop. By the way, this and last comment on that, and start early, right? This is just a great slide that shows there's 3 people on the slide. Susan is this person that invested here. She stopped investing right here. She put in no more money right here, and her money simply grew through compound interest to $600,000. Bill didn't start saving anything until that point, and he invested the entire way along to 65, and he never could catch up to Susan. And then Chris did both, right? Started investing early like Susan. And then when Susan stopped investing, he kept investing, and look at his results. The reality is compound interest is your biggest friend. Time is your friend when it comes to investing. It's the reason we talked about those tax deferred accounts earlier on. Like, you want to focus on it. Mistake number 4, instant gratification financed by debt. This might be a generational issue, but how common is this in our industry, right? People get into real estate and we're like, you should totally go lease a new car, right? The reality is we are buying things that we cannot afford. How's the Brian Buffini quote go to impress people that we don't know, right? We're spending money we don't have to buy things we can't afford to impress people that we don't know. Millennials are running up more debt than ever. And the best rule of thumb that we've ever come up with is if we cannot afford to pay for it in full, it's not time to have it. Do not finance consumer debt. Katrina, anything you'd add on this?
Yeah, I mean, I saw a commercial not that long ago from the 90s where I was talking about Burger King's now taking credit cards, and how everybody was like, I don't know about this credit card thing. And just realized that how much credit card debt is not a historical problem. It is a current age problem. And I think that the pendulum has swung to the other end, that people have so much debt, and we need to figure out ways to help ourselves not have so much debt, and then also coach our clients and the people that we serve to do the same.
Yep, absolutely. All right, number 5, diversify their income. Here's the chart that helped me think about diversifying income. If you haven't read Rich Dad Poor Dad, this would be another book to add to your bookshelf. But he talks about, like, there's 4 types of people, right? So you either are an employee, or you're self-employed, or you're a business owner, or you're an investor. What I want you all to think about is this. Each one of us earns income in each of these categories, right? So it's not one or the other. You actually have 4 different types of income that you earn. Part of your earnings right now might be as an investor. Part of your earnings might be as self-employed. The way I think about that top one is, how do you spend your time, right? Where are you trading time for money? Now, a lot of the people on this call, we don't actually trade time for money because we trade results for money, right? We have this winner take all or 100% commission job. You wish that you got paid for your time. Sometimes you feel like that would be a pay raise, but you actually only get paid for results. That's in the bottom left. And as you start to grow a team, you get paid for the results of others. That's what a business owner is. So there's 4 ways that I think about our income. And I actually look every year about how much income will we make in each of these categories. Katrina, anything on that? Otherwise, I'll just say we'll jump past this, but Gary Keller is a huge proponent. Just write down page 264 of the Millionaire Real Estate Agent book, because he talks in there about the difference between active and passive income. And, there's a whole story he tells, but here's probably the most eye-opening part to understand it. He says, listen, if you look at a monthly income stream of, we'll choose $300, understand that you would have had to invest $72,000 at a 5% interest rate to get that result. So when you start to think about passive or semi-passive modes of income, those little dollars actually make a huge difference, and it accounts for, like, you would have had to invest a lot of money to get that stream of income.
Let's get to the next slide. I put an example on that. So if you have $40,000, if you look at this chart, you'll make maybe about $150, $170 a month. But if you use that as a 20% investment down on an investment property, and you're getting $500 a month of cash flow, that's the difference between you getting $150 a month and $500. And in order to get that $500 just from investing money, you would have had to have $120,000, not $40,000.
Yeah, absolutely. Absolutely. All right. Mistake number 6. People make spending frictionless, and savings has a lot of friction. The reality is this: you just want to do the opposite. I was thinking, I bought something on Amazon today. I'm probably not the only one. And it's so easy. I can do it from a stoplight on my phone. It's so easy to buy stuff on Amazon, right? Understand, they do that on purpose, right? They make it extremely easy to spend money. Just like how the return department is at the back of the store and it's hard to return something, it's a lot easier to go buy it in the first place. And what we'd advise is make it way easier to save and make it harder to spend. So what are some examples that you notice in that?
So with that, if you're a W-2, almost every W-2, if you pay yourself a W-2, almost every payroll company, software, et cetera, has the option to have a portion go to one account, a portion go to another account. That's for savings automatically. If you get a raise and you're getting an additional $500, you're a W-2, instead of having that go into the same paycheck, just have that go into a separate account. You never miss it if you never got it in the first place. As a realtor, especially folks who are at our brokerage, we are happy to do that with your direct deposit of your commission.
Totally.
If you say, I want 10% of every check to go to another account, we can do that pretty easily. Any other folks who work for 1099s who get paid, see if you can do that. But having it be just automatic, you never miss it if you never saw it, is a really great rule of thumb there. But this is, again, where the automatic payments, if you have your credit card, your cell phone, all of those things just automatically pay out. You're not going to notice if prices go up. I know somebody who cancels their credit card every 2 years and gets a new one.
Absolutely. Absolutely. That's adding friction to the spending process, right?
Yeah, because everyone has to call them.
It says stop auto payments there, but Katrina, I love what you added. Start auto withdrawals, right? From your income into a savings account. We've had one of those for 15 years now, and we've just never changed it, right? Only thing we've done is change the amount, but keep auto withdrawals to your savings, but stop auto payments so it makes you think about stuff. Number 7, they don't get on the same page with their spouse about how to handle money. This probably wrecks more of us agents than almost anything else. Here's a couple of things to consider. 1, are you a saver or a spender? There's usually inside of a marriage, there's somebody who's more of the saver, there's somebody who's more of the spender. Sometimes just labeling it and understand who's who really helps. Number 2, especially if you are married to somebody that is a saver and you are the spender and you're prone to like spend inside of the business, understand that you've got to be willing to take chips off the table. That is, no, you don't need to go invest in your business and hire another admin. You need to like take this chip off the table and go put into another investment vehicle. Maybe that's a rental property. Take chips out of your real estate business. And third, the first thing that you're doing when you pull it out of your business is you're creating a family emergency fund, and then do not go raid that fund. Katrina, what would you say to that? I know you've had conversations even today on topics like this.
Yeah, no, I find also within this, it's not just your spouse, it's your family members, that there are folks who will end up, people who grew up of low means, who end up with greater means, and the friends and family see them like the bank account. Learn to say no to spending, and learn to say no to people who need a, hey, can you help me out? That it's really, really easy to give away money. Everyone will take it. So
put your own oxygen mask on first is a good rule of thumb. Mistake number 8, they don't have a scoreboard. So here are the 2 scoreboards that you need. You need to track your expenses. Again, we're talking about household budget. Track your expenses every month. And number 2, track your net worth. I I wish that I had started doing this sooner. It's actually only been in the last few years I've started tracking my net worth, but on the first of every month, I sit down with an Excel spreadsheet and I just go to my bank accounts and I impute every number. If you want a more automated way to do it, but again, be careful about automated, you won't think as much. Kubera is a great resource for this. If you sign up for the trial, send me an email. I can get you a code for $100 off, or read my newsletter. There's some instructions in there. But these are the two things you need to track. Mistake number 9, all offense, no defense. And this would simply be a list of the insurance or products that you need to consider. So my guess is everybody on here is set with home and auto. Not so certain about any of the rest of them, right? But these would be in the order. We might actually bump general liability up, but these would be in the order that we would generally consider these, or that we added them personally. Anything you'd say about this, Katrina?
Yeah, a couple of pieces. If you haven't had your homeowner's insurance reevaluated recently, maybe you should, because the cost of materials have gone way up. The cost to replace has probably gone way up since the last time you had it done, if it hasn't been recent. So that's thing one. Thing two, the short and long-term disability, completely transparent. Seth and I looked into disability insurance for him, myself, and Alice. And we found at the time, maybe it was $7,000 for the 3 of us to have good policies. And it was only $10,000 to add our 6 or 7 other employees. Yeah. So now it's a benefit that we offer to everyone, and it's a win for everyone involved. So make sure you're talking with an insurance professional to make sure that some of these things are great for you, but you can also create it as a benefit for people who work for you.
Yeah. General liability insurance, not terribly expensive. And of course, there's plenty others, but the reality is when we hear horror stories financially, it is usually because not that people weren't focused on offense, but something blindsided them in the defense category. And then lastly, they don't have a team, right? Personal mistake, they don't have a team. And so I want to know who is on your team, right? Who's your CPA or your accountant? Who is your financial planner? Who is your attorney that is the sorting out, especially stuff with estate planning? Who's your insurance agent? And then coach. Coach could be a couple of different things. Coach could be somebody, coach could be Katrina, right? Coach could be who is helping you stay accountable to reviewing these numbers or reviewing the areas that you are flirting with disaster on a regular basis. Katrina, anything else you would add on the team?
Nope.
Perfect. All right, so we are near the top of the hour. So we'll grab a screenshot here. If you've got questions, it's the way to reach us. If you've got questions, throw them in the chat. We will cover a couple things here. We decided after putting this together, like we are going to do a bit more of a deep dive. I'll talk about that in a second. But here's the upcoming classes. So here's things that we're doing. These are free. We want to teach. We love teaching, and here's what we're doing. So February 22nd, Katrina and I will be back talking about mastering your first hire. And then on March 6th, I'm going to be doing one talking about a lot of NLP, so neuro-linguistic programming and the language of persuasion. There's a couple great books that I'm going to be covering, like Exactly What to Say and Words That Work, some fantastic stuff. So hope to see you there. You can sign up here. But if you want to go deeper,
side note on the first hire, it's not necessarily the first time you're ever hiring, but it's like that foundational administrative person who you're going to build your business on. You may have screwed it up 4 or 5 times, which is why you need to be at this. It's not hiring the first.
You probably did. You've probably already done this and it didn't feel like it went well. I'll just tell you, Katrina was my first hire that I got right. And when you get it right, you get it really right. So we want to teach you how to find a Katrina. Okay, we are going to go deeper on this though. So if you want to go deeper on this topic, we are going to put together another 3-hour training that will be a much smaller, a lot more interactive, and we're going to send out homework ahead of time, but we're going to dig deep into some of this content, but we want it to be a much smaller group. So we're going to be doing that. You can grab the QR code here to get it. It says $297 on there. That's what it will be in a couple of days. We're going to give you guys a discount if you are live on this class right now. So here's some of the stuff that we're going to walk through with it. We're going to work through a budget for your business and finances, walk through your P&L, give you an example of a personal net worth statement and help you work through it for you, and then leave there with an action plan. So if you want to do that, if you are on this call right now and you go to that QR code, use live 100 to take $100 off that. So it's $197. Katrina, anything you want to say about that?
Yeah, I think based upon the conversations that we had here, we might dive a little bit deeper into paying yourself as a W-2 and S Corp, and a little bit of those pieces. I heard that as a couple of topics, and I've taken screenshots of all of the questions that we couldn't get to or that we could deep dive on, and we'll add that to the content as well.
Yeah. So are there any other questions? All right, guys, we are officially at time. 2 minutes over. So we'll stay on for a couple minutes, but we appreciate you being on here. And if you've got a question, that'd be a great time. Raise your hand. I'm just going to scroll through these a little bit as well. And yeah, awesome. Howard, I'm glad you connected with Meredith. She is a dear friend. Help her in any way that you can. Appreciate that. Any other questions, drop them in the chat here. I'm actually going to unshare that for a little bit. Let's actually comment real quick. And I don't know if I've got this right or not. Everybody can see my hand if you're still on here. I want to go back to that whole S Corp conversation.
Hey, Seth, unpin me.
Unpin Katrina. Okay. Think you also.
I unpin myself.
Okay. I think you could. All right. So I want to go back to this S Corp conversation. So the concept of an S Corp is that the government wants you to pay more taxes. Can we all just agree? Like, you just need to understand how the government thinks, right? So the government wants you to pay more taxes. Your goal is to pay as little taxes as possible. So this S Corp conversation says that part of your income is going to be, if this is all of the income, you're taking all of, oh good Lord, let me just make this a little bit bigger. You're taking all of the income and you're breaking it into two parts. Okay. We'll just make it equal for now. And one part is distributions and one part is salary. This is sort of what happens when you go into an S Corp. So the question is, if you made $200,000, right? How much do you want to go into salary? And the answer is you want that number to be as low as possible, because any part that is taxed as salary, you also have to pay FICA and Medicare. Okay, so this is going to cost you an extra 15% on this money. Okay, and somebody who knows this better than me, by the way, I will not be offended when somebody tells me they know more than me on this. If somebody can correct me and say that's only 7.5% on this money, I would believe them. But either way, we pay more taxes on the part of our income that is taken as a salary, okay, that is paid through the W-2 in an S Corp. And we pay less taxes on the money that is a distribution. So if that's true, you're listening to that and you're like, well, I got a secret to that. I'm going to pay myself a salary of $1, right? I'm going to pay myself a salary of $1 and I'm going to take all of the income as distribution. So what happens? The IRS comes in and they say, this salary is not consistent with somebody of your stature in the role that you're in, and they disallow it and they penalize you and they make you pay the FICA and Medicare on all of this. So if you talk to your CPA and they say to you, oh no, you've got to pay yourself enough. You're like, well, that feels like weird language, right? Because shouldn't I want to pay less taxes on this? And the answer is, yeah, you want to pay as little as you can, but enough that you don't get flagged by the IRS and perhaps risk paying this extra tax on all of this amount. Okay. That might have added a massive amount of confusion. It might have helped some people. I really have no idea. All right, Katrina, were there any other questions out there?
So what's a reasonable salary to replace this job? Howard, which job are you?
Yeah, and so I know Howard, so I'm not sure if he's asking that specific for him or not, but the way I think about it is sort of a generic, like if you're the CEO of a small business, right? My accountant, I just know that he pulled up some research and he gave me like, here's the range, and I think you're less likely to be audited. Candidly, our number in that is somewhere between 75 and 100 and 100,000. And I think I paid myself that and my wife that number. And then anything over that we take as distributions. Okay. The danger of making that number really low, right? $40,000, they'd say, nah, that doesn't pass the sniff test. And at the same time, I want that number to be as low as possible. I would need to Google that to do more research if I was picking it out again.
And that's where talking to the CPA and understanding what, depending on your level of business, you might choose to take more 1099 or choose to take more W-2. You just want to decrease your tax liability, and we are not tax professionals.
That's right. We are not CPAs. We're not attorneys. Go find your own and rely on their advice. Whatever you do, don't rely on this advice. Guys, I hope this was helpful. I really do. And we'd love to do more of a deep dive with you. And if there's other content, again, we're trying to just get as much of this content out into the world as we can. We love it for our agents at our brokerage in Maryland and for our friends around the country. And if there's anything else that we can do to be a resource for you, we would love to. And Sherilyn, great comment. Remember, your SEP contributions are only 25% of your income. So there's a few different calculations to consider. So like the penalty or the drawback of making it a low number is that now 25% of that number is a lower number, right? So there's a few different things to consider to find the right spot for you. And that's absolutely another thing to consider. That's great. All right. If there's no other questions, seeing no hands, seeing no other questions or comments, then we will break. Appreciate you all. Have a great day and talk to you guys soon.
Bye.
Take care.